and welcome to FS Brew. FS Brew is Region's first podcast focusing on all things insurance and insurtech here in the UAE and the wider Middle East. I'm Ranjit Philip. I advise startups on their business models, go-to-market strategies, funding, and unit economics. I'm deeply interested in the fintech, insurtech, and DeFi space, and I'm very happy to be here with you all.
Hi, I'm Vidya. I'm the founder of Forward, a startup that works with insurance companies to accelerate their go-to-market propositions, digital transformation, and digital marketing initiatives.
So, hi, Vidya. Who are we meeting today?
Ranjit, today we are meeting Hatim Maskawala. Hatim Maskawala is the managing director of BADRI Consulting Services. So Hatim has over 2 decades of experience in health insurance, general insurance, and life. He's worked with multinational and blue chip companies like Adnec, Tokio Marine, Allianz, and Ernst & Young. He's a registered actuary in UAE, Bahrain, and Saudi and Oman. He's worked across other geographies as well. He's managed to adopt the best practices across jurisdiction to other places. I'm quite excited to have him on board because he's got some really cool stats about the market, which I don't think the market is aware of. So Hatim, thank you so much for joining us and welcome to the show.
Welcome, Hatim.
Thanks a lot. Thanks a lot, Vidya and Ranjit, for having me here. It's a pleasure engaging with other market players as well. And this is something that we have been also trying to do passionately in all the reports and all that we undertake.
Awesome. Okay. Hatim, before we kick into this really statistical sort of information and then hardcore, conversation, I wanted to ask, and this is typically something we ask all our guests, is how did you get into insurance? And, talk us about your role at BADRI Consulting, please.
Okay, so how I got into insurance was not a planned move that this is an industry I want to go into. I was actually undertaking ACC examinations. And after the first year of the examinations, we were looking for a job, and there was an opening in Allianz in Pakistan on the finance side. So I had joined the finance department of Allianz, and after completing ACCA, it was more of, now the thing is that 1 degree is not enough. So what do we do? So I was speaking to a teacher, and he mentioned that, you're good in math, so why don't you look at actuarial sciences?
Right.
Okay. So that is where I started off in actuarial sciences. And as I progressed in the examinations, I left Allianz. I joined a consulting firm, which was a member of EY back there. And after that, I had been working in UAE. So in consulting, I was working with Ali, who's also co-founder of BADRI. And now we were thinking, what can we do? Like, we have enjoyed consulting. We've also experienced the company environment as well. So then that is where we thought of sort of setting up BADRI as an actuarial consulting and sort of other areas as well, because we understand the operations now, and we also understand the pain areas that companies face, and we are trying to solve that when we started off. Because initially, when we started off, actuarial science was not a very well known in this market. That it was something that was new coming up. Yeah. And with the financial regulations coming in, it has really helped. Like, companies have changed a lot over time. So yes, we set off BADRI primarily on the actuarial front. Then we also sort of expanded to other areas like finance, BI, business intelligence, analytics, HR consulting. So that's sort of the background.
Perfect. All the guests say that they kind of went into insurance by accident, but they kind of stick around, and so have we. So, that's the good story. And so you talked about actuarial science, and, I had the good fortune of taking a look at the presentation that you had shared, I think, with the industry a few months back. And one of the couple of things that you brought out in that hot topic of motor portfolio was about discounting and below burn cost pricing. So could you share a bit more for the audience, keeping in mind that many may not be familiar with some of these terminologies and trends? So it'll be brilliant.
Okay. So basically in motor, if you look at the history, so this started off in 2017. In 2016, the insurance authority at that time, they came up with a sort of a unified policy. that this is the unified policy, and there were certain benefits which were new, and one of this benefit was rent a car. So initially when it came out in 2016, a lot of people thought that rent a car will be very expensive. We have to provide a rent a car for up to 10 days. It might cost up to 300 dirhams, that's 3,000 per accident. That's a lot. So the authority had asked all the companies that, what do you think are the right pricing ranges for these benefits? And based on the feedback that they got, they sort of came up with minimum tariffs, that this is a minimum tariffs that you have to charge, and they go from a minimum to a maximum. So initially in 17, when the unified policy became active initially, most of the companies, they were charging midway between the minimum maximum, or maybe towards the higher side. Very few companies were on the lowest point only. Over time, what we have seen, the loss ratios have been good. The utilization has not been that much of these sort of benefits. So because of that, what happened was it was very profitable. So if you look at the results of 17, 18 of the insurance industry, the profits have been very high. And the main driver behind these high profits was motor itself. There were some losses happening on medical, but still it happened. So yes, when we talk about the burning cost, we are basically referring to how much claims we'll be paying out, plus any commissions that we pay out and our own expenses. So if you average it out on a particular policy, let's say for a certain benefit, or for a certain risk characteristic, you're supposed to charge a certain premium, and that premium might be, let's say 700, and you try to sell that policy at 600. So the expectation is that you will end up making a loss. So this was what was happening. So in 18, companies realized that, we are charging very good rates. Let's start giving discounts. So towards the later part of 18, 19, we saw the prices coming down. 2020 would have been very difficult for the motor insurance industry if it had not been for COVID. Because of COVID, there was a lockdown, and because of that lockdown, what happened was motor loss ratios went down. So that is one thing that has happened. So 2020 was just because there was lesser vehicles on the road, the loss ratios were down. The price competition continued. And at that particular point in time, there was a circular that came out in 2020 that allowed companies to give up till 50% discount on the minimum rates. So the entire market has sort of shifted. Like, there were a lot of conditions around that, but some of these conditions were quite vague, like, good loss history or a loyal customer. So that is something that you can fit for everyone. So by default, many companies have started giving up to 50% discount below the minimum price. Now remember, minimum was already low. There was a range above that, but now companies have gone up to 50% below the minimum. The other thing that has started happening over time is the commission rates have started going up. So in 17, 18, when the broker community saw that, this is a very profitable book of business. So the motor commissions, which generally used to be in the range of 10 to 15%, have now gone into a range of 30 to 35%. This is not the overall average commission. The overall is much lower because there's a lot of business that is placed directly, or fleet business or other types of businesses. But still, the smaller players who are reliant more on sort of brokers, they had to sort of pay these high commissions. So on one hand, the premium is dropping. On the other hand, the loss ratio, now things are sort of going back to normal. So what is happening is we've started seeing those losses coming in the motor portfolio.
Understood.
Totally. And I think, like you said, everyone has done a catch up and everyone wants to be in this mix of, let's give more discounts sort of mode. So since it's a very hyper competitive marketplace with lots of players in it, what are the genuine steps you think that can be taken to protect the industry from a, almost like a meltdown scenario at this point? So, and also, did you, in your sort of analysis, did you find any surprise findings that you can share with us?
Okay, so the question that you asked about what are the steps that can be taken to protect the industry. Now, there's a thought in the industry that, the regulator will come and take action. An analogy to this, which like we were speaking to a CFO, and he said that, if you know that your hand is burning, do you wait for someone to take it out for you, or will you take out your hand from the fire yourself? So similarly, sort of the industry is placed in a similar fashion where they're waiting for the regulator to take action. theoretically, this discipline should come in from within the industry itself, that we need to undertake proper pricing. This is the risk that we are underwriting, and this is the cost or the premium that we have to charge for this risk. At the same time, because of this discipline, what I've noticed is the larger players, the multinationals or the bigger companies in the market, which are run professionally, they are not part of this competition. So you do not see their prices dropping to such low extent as compared to other companies who might be mid-size or smaller companies. And some of these companies are already having solvency issues.
Right.
So what we have seen is that they are trying to sort of rotate cash flows by getting in business at sort of lower rates so that they get the cash in and they're able to pay off the claims that are coming in. But this is not a long-term solution. One of the things behind this has been that, for years, the solvency regulations have been there, but they have not been enforced very, very strictly. So the regulator has been patient with the companies that, okay, you have a bit more time. Okay, you correct this. The regulator has been patient in the past, but now with the insurance regulation going under central bank, we feel like, and again, this is a personal opinion, that I feel that, being a banking regulator coming in from banking background, they might not be so patient, especially when it comes to solvency or prudential regulations.
Yeah.
And we have actually seen this recently, a week or so back. The central bank has sent emails to all, like most of the companies that I know have solvency issues. They've sort of sent them emails that, you have until 30th September to rectify this position. And they've given sort of a list of things, and we'll be talking with you on we want a plan on a monthly basis as to how we are progressing towards that. But 30th September is the final deadline. When your financials come in on 15th November of 30th September, if you're not solvent by that time, we will take regulatory action. So this is the first time we saw a very, very strict note from the regulator going out to companies, and they'll be meeting the companies over the course of next couple of weeks, and they mentioned that we'll be following with you on a monthly basis now.
Wow. Yeah,
So,
I can
this
sort of
strict, yeah.
Sorry, Hatim, if I may just interject, I think that's a very good point that you mentioned, because now the regulators are the same. As I was in a finance company, I know that we had very regular and strict interactions with the UAE Central Bank as part of a finance company, and I can imagine that kind of scrutiny coming into insurance companies.
Coming.
Yes. So now what we are expecting is, because of this will push companies to, okay, now the business that we're doing, if it is loss making, we cannot continue doing this. It's no more rolling of cash only. So I feel that, this will sort of push companies to start improving the prices.
Yeah, absolutely. And I think it kind of plays very well into the next question that I want to ask is, now that there is a deadline and solvency issues, one way you can bolster balance sheets is by, getting together mergers and acquisitions. So let's talk a little bit about the consolidation in the market. We have been talking about it for years now. Industry has been looking for it, and there have been some movements of late as well, as you know. What do you think will be the drivers for consolidation in the market? And do you think this time it will happen on the back of central bank pressure? Is it also going to be aided by IFRS regulations that drives it? Would be good to know your thoughts.
Okay, so yes, we have been talking about consolidation for a very long time. I used to be one of the skepticals who would say that we just talk about this as nothing is going to happen, because over the past, like I've been in the country for around 14 years now, and have been involved in certain transactions earlier on that never materialized.
Right.
But recently we have actually seen consolidation happening. We have actually seen deals going through. So if you think about Dar Takaful acquiring the two companies of Noor Takaful, that was one of the first deals in UAE. GIG sort of acquiring AXA. That is also, and that is a sort of game changing. These are sort of deals which are changing the market. And at the same time, there are quite a few deals which are in the pipeline. We do get involved in certain things on a consolidation side. If you look across the border at Saudi, there the pace has been happening very fast. So we've seen three, in fact the fourth one just happened right now, and 3 or 4 more in the pipeline. So in Saudi, a lot of deals have happened. There the push is coming in from SAMA or the central bank over there. that you need to do this quickly, because they also feel that there are certain companies, and the regulator is also sort of pushing and following up regularly. So I think with maybe with things with central bank being the regulator, and we have seen a lot of consolidation in the banking industry in UAE in the past. So
Right.
because they have gone through this process, they probably have more experience on this side. So my feeling is that with now central bank being there, these sort of things might change, and we might see more speedy sort of consolidations happening, because that is sort of needed in the market. With regards to the point that you mentioned about IFRS, like yes, right now IFRS 17 implementations are going on. But I feel that at this stage, IFRS 17 is not going to be the driving factor, because companies are just trying to understand what is IFRS 17. So I don't think it will be the driving factor, but the driving factor might come in more from the solvency regulations, or the fact that because of competition, companies are losing money. So, let's sort of get together, become a larger company, and then sort of compete with a bit, like where we can benefit from economies of scale.
Right.
Got it.
So, on to my next question. What really piqued our interest in the recent past was, the report that you brought out, BADRI's report that was brought out on the public listed companies, YTD Q3 performance. And there were some really startling numbers there. The underwriting performance had taken a serious hit. Now, do you have any sort of early views on how the whole 2021, the year has ended? I would imagine it to be very similar to what we saw in Q3. Maybe you can talk us through some of the stats, and if you have any views as well on the whole year itself.
Okay. So we don't have the sort of final numbers right now, because the companies are at this point in time, like we're mid of January, they're trying to they're in the process of closing the financials. But actually, like reserving itself is an important part in that financial close process. So one of the things that we are noticing as part of reserving are the trends of Q3 of deterioration are continuing to deteriorate. So we are seeing the loss ratio going up. There's no more lockdown. Everything is open. Yes, there is some variant still coming out, but at the same time, UAE said that there will not be a lockdown, and we'll try to control it. So we are seeing more cars on the road. Schools have opened up, and it's even in December we saw much more sort of tourists coming in. So what we are seeing right now is the loss ratios are on the sort of upward trend. So from Q2 to Q3 to Q4. One thing that did happen was last year when there was lockdown and a lot of losses were not coming in. The companies in the UAE, in my opinion, were conservative. So you did not see very high profits being reported in 2020. Whereas the claims were not there. So companies, because of the uncertainty, they were probably a bit more prudent on the reserving side, and that prudency might be released in 2021. That's one expectation. And at the same time, so 2021, you'll see the impact of things coming down. Let's say the conservative reserving of last year might help the companies to a bit, but from what we are seeing right now, or the initial numbers which we are looking at as part of reserving, the losses are increasing. So the underwriting profitability is going to decrease further, YTD as compared to the previous year.
Right. Okay.
Investment income on the other side has been helpful. So investment income and real estate values are sort of up. So that might save some of the companies.
Right.
Yeah. And, hopefully there could be a, raise in interest rates going forward. So that will only help in the investment side. Or it might dampen some of the other enthusiasm in the market, but, at least from an investment side, it might help. Now, just going into the IFRS 17 piece, this has been postponed and the can has been kicked down the road for a while in the industry. In your view, what are the sort of challenges that are facing the industry in terms of adoption and implementation? Why is it not moving at the pace that it should?
So with IFRS 17 coming in, I think more of a challenge is, if you ask me, one of the things is the understanding of the standard. Now, if you look at insurers on the European side, they've come in from a Solvency II implementation. So they're used to terminology like what is the best estimate of reserving, what is the risk margin on top of it. when we are setting reserve, what is the confidence interval we want to be on when we are reserving. These sort of terminologies are not very familiar with companies in the Middle East and in UAE as well. So one of the challenges I feel is more of understanding of the standards. Companies are not understanding it properly, and then they are relying on consultants to come in and implement it. So consultants can help you out, but if you don't want to understand or you don't learn what they're trying to do, after a while they'll leave.
Yeah.
And in fact, this is one of the fears that the Saudi regulator has said very openly. So, right, toward the end of like on 30th November was a deadline for the first dry run in Saudi. And after that, SAMA called all the companies in that you come in, the company management only, including the appointed actuary. The appointed actuary is part of the management. The appointed actuary plus the management, you come in and you present your numbers. The thought wasn't about the accuracy of numbers, but rather, did you understand the process you went through, or were you just reliant on someone? So that is one thing that is happening across the border. In UAE also, companies are now sort of picking up things. One of the issues is like companies believe that, and it has been, partly consultants are to be blamed for this, that, you buy a software and everything will be okay.
Yeah.
So software is not that sort of a golden pill that will solve all your problems. Yes, it might make the process easy. So whether you have a software or someone who doesn't have a software but understand the standard, he'll still be able to prepare the financials.
Yeah.
Because ultimately some of these vendors, what they say is, okay, you give me the data in this format and I'll prepare it for you. But to give the data, to understand the data, like I'll take a very simple example. In this market, when we say claims paid, now that claims paid is not actual date on which that payment has occurred. The paid is the date on which that debit note or the credit note was issued.
Right. Yeah.
So now people have to start recording that actual payment date when the cash left your bank. This is one side of the story. The other side of the story is premiums. So here there's a concept, okay, you'll for 10-20 policies, you'll just get one check and it's payment on account. So it's not actually allocated to each and every policy. That is one challenge. The other challenge is that you might not have it at a policy level. You might have it at a counterparty level. So let's say there's a broker involved and you have it at a broker level. So these are some of the challenges now that companies are realizing, and now they are sort of amending this. So I think it's more about understanding the standard, get familiar, get everyone. It is complicated, but it can be simplified as well. If you understand the background, it will be simplified. Think about how you would do it manually, and then how you would use a system to help you, not to solve all your problems, but just to help you in the process.
Motor pricing has traditionally been done in the old way by our underwriting teams, and you mentioned in your presentation about general linear model, machine learning based models. So what do underwriters and pricing actuaries need to do in these companies to upskill themselves and prepare for these changes? And what is in it for them to adopt these changes? I mean, you could almost think that, hey, are these models going to replace me? What is your view of the industry in this regard?
Okay. No, it's not going to replace anyone. Traditionally, UAE has been a sort of a flat rated market, or a broker rate, where the broker would want one rate for all the types of vehicles, one for saloon, one for 4-wheel drive. And even within the companies, when they were giving out rates, they used to give out a tariff sheet, that these are the rates to the branches to apply. When you're doing that, you're not looking at all the other risk characteristics. Like one example could be that, when we are looking at vehicle value, so we know the more expensive vehicles, the lower the premium rate. That is one part. Then when we look at models, we see, okay, Mercedes, the rate is low. But what we miss out is the interaction between the fact that most of the Mercedes are high value vehicles.
Yeah.
So with generalized linear modeling or more advanced sort of pricing, what happens is it takes into account the interaction between these different types of variables. So how much of the, let's say, the trend is because of an interaction between these variables, between 2 or 3 different rating factors, and how much of it is, actual sort of experience and all. So it allows for this. It gives more sort of power to the underwriter, saying that, rather than looking at 1 or 2 variables only, where, we were traditionally looking at, let's say, for third party, the vehicle cylinders, and using it as a proxy for everything else. Here we can look at more variables. So if you sort of like the Saudi regulator, they mandate for third party, you have to have minimum of 11 rating variables.
Right.
And for comprehensive, you have to have minimum of 13 rating variables. Now, if you were to do this, the way we were doing pricing traditionally was what we call a sort of burning cost approach, or so all the factors were considered independent. Now, that sort of things can happen in 1 or 2, 3 variables, but when you have 11 or 13 with all the different combinations, it's very difficult or sort of not recommended to do things like this.
Yeah.
So that is where more advanced methodologies like generalized linear modeling, and GLM is not a very advanced now. It's something which was sort of outdated now on the European side, but that is the next evolution from a flat rated sort of rating to the next step would be generalized linear modeling, and then you would move into more sophisticated and eventually go into things like machine learning. So this will sort of help, and the reality is companies have started doing this even in UAE right now. Relatively less. So, you've done, let's say, GLM for maybe 4 companies in Saudi, but only 2 companies in UAE. But the trend is picking up. So if they do not change this, if the underwriters do not change the approach or the pricing actuaries, the actuaries are aware of this. Most of the actuaries are aware of it. They at times they get frustrated that we are trying to do something new, but the market is not accepting. But now the reality is that if you do not change, if you still give average rates, so the ones which are cherry picking the good risk, they will get those policyholders maybe at a lower premium, but because they had a lower premium, they're getting those. And those who are not doing this, they'll end up with what we call sort of a badly priced risk.
Yeah.
Or giving an average rate to someone who should be a sort of a high risk this thing. These sort of things will now, so this is one thing that you've been hearing on the motor side. A lot of people have also been talking about telematics. Now, what telematics does is it increases your rating variables. Previously, you were looking at vehicle only. Now you also have driving behavior as a rating variable and the different types of measures that you have over there. So when you bring telematics in, and there are companies who have started on this process. So if the companies who have not started, if they don't do it now, this is the learning. I'm not saying that telematics or GLM is sort of bringing very high profits to companies right now, but they have the foundations in place. Tomorrow, when the companies start applying this, which some of them who have already done it, those who are not there, they will then feel the pain.
Yeah.
So, and this is the same thing that you see on the European side, that most of the companies are using GLM. Everybody does look at your area code and a lot of other factors that you have, because that is what you have to do to stay in the competition.
Absolutely. Yeah. And then, as you learn, the hockey stick effect of data will start kicking in. So the sooner they do it, the better it is what, is probably what the message is.
Exactly.
Right. Awesome. So, onto our, market in the UAE. Now, you've mentioned, the whole reliance on motor is taking a toll. This market is very much a motor and medical driven market. And we've seen the backlash of, this heavy reliance on these products and the stiff competition, which just makes it very difficult for companies to thrive. Now, is there a headroom for non-motor, non-medical based products here? Have you done any sort of headroom analysis that you can give us insights on? We are seeing some sort of a trend on pet insurance, but it'd be good to know if there is really some sort of a data backing this.
Okay. Personally speaking, I feel that products like pet insurance, they have more marketing mileage than actual profitability, because the volumes are still small. That we are talking about. What the market is sort of can capitalize on are the commercial lines. So there's a lot of commercial risks that the market is underwriting, and then they're reinsuring it out. So what is happening at the same time when they reinsure out the risk, they're also reinsuring out the profits. So a lot of this is profitable. Yes, we do hear of one-off large claims. Extreme events happen, but that is how the insurance, the concept of insurance works. That you are sort of pulling everything in together, and for the extreme events, you will have non-proportional or excess of loss coverage that will take care of those fluctuations. But here the tendency is most of the large risks will fact it out, or we have heavy reliance on quota share. So companies, they don't go outside of what the treaty leader or the facultative party is dictating. And
Right.
that
And
is
what
where
is-
the profitability sort of comes in.
Right. And so, but what is stopping those companies from retaining more in commercial lines business, considering the retention ratios are pretty great here?
So I think this is more of I would say technical skills is there.
Yeah.
The
Right.
fear of taking that risk is there. So first part is technical skills, because when you're underwriting a commercial risk, or let's say you're underwriting an oil refinery, you need specialized skills.
Right.
The benefit of using a fact partner would be that, they are able to, that sort of partner will do all the work.
Yeah.
So the underwriting part, looking at property, doing a risk inspection, all these sort of things are then handled by that reinsurer partner or the facultative leader. So companies need to start sort of building in their own capacity over here. The capacity from capital perspective is there with many companies, but the capacity from a risk understanding perspective is not there. Getting those technical skills in, understanding the risk, the link between the risk that you are taking and the capital that you have. So people are fearful that, what if we have this one loss, it will wipe out everything. But that one loss would be reinsured on a excess of loss basis.
Yeah.
And when you have a large so one of the a very simple analysis that we do for companies as part of our reports is RI premium minus RI claims minus RI commission. So what was the net profit that the reinsurer made from you? And some of these numbers are very, very large.
Yeah.
Right.
And one of the examples that we give companies is, okay, let's take the past 10 years. If you had no reinsurance at all, now that's a very radical concept, but supposing you had no reinsurance at all, this is what your profits would have been. And yes, you had fluctuations, you had ups and downs, but I'm talking about a 10-year period. So for normalizing those, you get an excess of loss. So companies don't undertake proper reinsurance optimization. Their brokers provide the service for free, the reinsurance brokers. But then there's also conflict of interest over there, because they provide the service for free, and then they also benefit from the reinsurance placement. If you look at other parts of the world, larger companies hardly use quota share. Most of the reliance is on excess of loss. And that is, at the same time, that is why you have so many large reinsurance companies in UAE based in DIFC.
Right.
Because they need offices here, they need people here, but at the same time, the profits are going out.
That's right.
UAE does not stop companies from reinsuring high, but it is hurting it. It is profitable business that they're seeding out most of the time.
That's right.
I think it's a deeply ingrained risk-averse, mentality of direct insurers. Yeah.
Yeah, and it's a big capability game as well, right? So now you have to source quality talent at high prices for this kind of thing, and you have to build that base up. So it's a big, interesting multi-year challenge, I guess.
Yeah.
And the profits that you're seeding out are in millions.
Yeah. That's right.
Yes, the talent, the commercial lines underwriters might be, let's say, companies might perceive them to be costly, but look at the overall picture that they're putting in front of you.
Yeah.
Sure. Yeah, makes sense. So in the retail side, you are saying that pet is or any of those upcoming products maybe at this point is from a marketing perspective, but not more so from a profitability point of view.
So these products are generally profitable. One of the other products that I've seen being very profitable is travel insurance.
Yeah.
Even in the current scenario that, where it's being utilized, and this is the right time to in fact sell travel insurance. Home contents is a product that is sort of not sold that much in UAE, or people don't understand. So it's normal, like even with my rental agreement, they charge me some amount of premium. But who is it going to, which company? I hardly got into that, being from an insurance background. So these are sort of products that are there, sort of bundling of products. And now we are starting seeing more of that. We see a lot of advertisements from Etisalat offering that, we'll give you this cover or we'll give you that cover. And again, obviously that is coming in along with a sort of insurance company behind that.
Yeah. True. Great. Yeah.
Perfect. So, before this has been a great session, obviously. And before we end, we always ask our guests, is there a message that you would like to send to the industry in the UAE or outside? and it could be a personal one or a business one. Please feel free to use the platform.
Okay, so it is more to do with one of the questions that you asked earlier about consolidation, and one of the things that are driving this consolidation is what we hear a lot about digitization or AI coming in. That that companies are setting out digitization strategies, and that is going to solve all the problems. That is a lot of investment. That is expensive. But maybe at times it might just be good just to technology is going to be the enabler. If you understand your business. So sometimes it might be good just to take a step back, understand, just go over the fundamentals again, start from the fundamental principles of insurance. What are you doing right? What are you doing wrong? And then use technology as an enabler rather than using. So in many companies I've seen that oh, we can't do this because the system does not allow. So a lot of projects get shut down because the system is not allowing. Maybe there's a workaround. Maybe system is not the only, it's not going to solve all your problems. So yes, digitization might be good, technology might be good if you know how to understand it, understand and use it well. And if you understand your business. So don't and the other thing is, don't assume you've done this in the past, it will work in the future. A lot of things are changing. So I guess that would be my message, that yes, digitization, systems, everything is good if you know how to utilize it. If that's what you're lacking, you need to take a step back, speak with people, and try and think about how you can change your business to succeed in the future.
Yeah, that's a great message, and I think that gives us almost the title for the podcast. Start from the fundamentals and reinvent yourself. Brilliant! It's been fantastic to have you here, Hatim. It's been a pleasure.
Absolutely.
Thanks a lot.
Thank you so much for sharing all your insights. Thank you so much.
Thank you. It was a pleasure being here.